We have a very, very special guest with us here today. We have Mr. Ashish Gupta, who's the Chief Investment Officer of Axis AMC.
To have a long-term view about a stock, whether it should be bought or sold today, what you really need to address.
If you were to sort of tell me 2 to 3 industries that according to you for the next 5 years, 10 years are going to outperform the Indian market.
Do what you do while driving, right? You look in front, don't look in the rear view mirror and drive.
Is the 30% return going to continue? Right? So, guys, the party doesn't go on forever.
There's only one company that is benefiting from all the infrastructure creation.
We
that
know
is
what that
happening,
company is,
right?
the one that makes the shovels.
Yes.
Do you think us Indian investors should get some exposure to these global markets? Hi everyone, welcome to another episode of Cashvisory's podcast. I'm Utkarsh, the co-founder, and we are on a mission to get every single young Indian to their first investment. We have a very, very special guest with us here today. We have Mr. Ashish Gupta, who's the Chief Investment Officer of Axis AMC. So he's someone that leads the direction of what a mutual fund company does, and we'll get to learn so many things from him across this episode. Welcome, Ashish. So glad to have you on a podcast episode here today. Very excited for the conversation that we're going to have. Would love to hear your journey in your career so far and what led to you becoming the CIO of Axis AMC.
Sure. No, first of all, thank you for bringing me on this platform. Happy to be here. I think it's been an organic journey for me. I did not start out planning to be CIO of an asset management company. In fact, when I started out, I did not know the CIO role existed.
Right.
After my MBA, I actually joined the financial services industry, but on the credit side. So I used to actually give out loans. I used to assess companies from their credit worthiness perspective. Did that for 5 years. From there, I moved into analyzing companies not for their credit but for their equity outlook.
Right.
And ever since then, the bug of equity markets hit me, and the last 25 years I've been looking at the equity markets both in India and overseas. A large part of the time was spent as an analyst, and I've had a couple of stints on the fund management side, and so I was an analyst covering multiple sectors over the nearly 20 years. Wow. And then I moved into fund management.
So that's amazing to hear, Ashish. And for the sake of our audiences, if you could explain to them what does a research analyst do? What does the day in a life of a research analyst look like?
Sure. So a research analyst job is quite interesting. It is about forecasting the future of a company, of an industry, and at the end of it, a stock, what its future prospects are going to be. If you are really looking to have a long-term view about a stock, whether it should be bought or sold today, what you really need to address is that, okay, in the future, will the company be bigger? Will its sales grow? Will its profits grow? And at what pace it will grow? What will be the expectations of the market today about its growth prospects? And is it going to be better or worse than that? To get to that answer, you have to look at multiple aspects. You have to look at macro aspects. So is the economy growing? Which parts of the economy are going to grow faster than other parts? So is the company going to participate in the faster growing parts of the economy? Then within those parts of the economy, which industries and then which companies are going to do better? But again, this is only part of it, because at the end of the day, returns are a relative play. So you have to look at not just one company or one market in isolation, but how is it relative to other companies and other markets, right? So only if its prospects are better than other companies and other industries, then it becomes more attractive, and that means more people will want to buy this stock. So it's quite interesting, and really you are at, I like to imagine it as a web. So you are at the center of the web. You have multiple dimensions of information that is flowing to you, which you have to analyze and kind of keep refining your views. Again, it might seem like a static process that you are coming to a view at one point of time, but because it's a dynamic environment, you need to keep updating your views.
Absolutely, absolutely. And that's an amazing summary of how do you go about analyzing and selecting investment opportunities. But to a lot of our sort of retail investors, the process might seem a bit overwhelming, right?
Sure.
So if you could sort of tell them what are 2 to 3 North Star metrics, according to you, that you should focus on while selecting a company.
Sure. I think first of all, while selecting a company, and particularly for the retail investors, newer investors, you should look at the things that you understand best. Okay. And it might appear very mundane. It might appear a company selling a toothpaste. If you believe you kind of understand that business better than a company making a very interesting new drug discovery, I think you should kind of focus on things you understand better than things you don't, because
Absolutely.
things you don't understand, you are going to rely on someone else's view. Most of the times, even if those views are correct, by the time you hear it, everyone else has also heard it. And in the markets, we have this concept of what is priced in. Right?
Yep.
So if what is known is already in the price, then buying it will not give you superior investment outcome.
Absolutely.
So I think you need to stick to what you know best, because that is what gives you long-term belief in it.
Yep.
And if you have belief, that's the only time you can hold something for the long term, because really the best returns are made when you invest for the long term.
Absolutely.
Right? So I think first is you focus on things you understand. The second is, and I personally try to focus a lot on earnings, because I believe at the end of the day, returns are an outcome of earnings growth.
Absolutely.
So if earnings are going to come through, and if they are going to grow at a decent pace, more often than not, you will end up with good outcomes. The third thing to look at is really quality in 2 dimensions. One is how good is the balance sheet and the cash flow of a company.
Yep.
So some companies can grow earnings, but to grow earnings, they need to keep taking increasing amount of debt. So you need to have good balance sheet strength. You need to have good quality management. So I think these 2 aspects, earnings and balance sheet and management strength, are the focus areas.
Got it. Fantastic. And love the fact that you talked about earnings and the growth of the earnings, and the sort of moats of the company that
Yes.
enable that growth to continue and
Yes.
outperform the other companies in the industry. So that's an amazing takeaway. And you also alluded to the fact that identifying those trends, those industry, those sectors that will outperform the broad market. So putting you on the spot a bit here, but if you were to sort of tell me 2 to 3 industries that according to you for the next 5 years, 10 years are going to outperform the Indian market.
Sure. See, I think if I take a really long-term view, right? So one sector that's always kind of close to my heart is the financial services sector. There are various components of it, but really, if you believe in India and India's growth story, then financial sector is going to be a prime beneficiary, right? So if you look at any part of the financial services sector, anytime an economy grows, the financial sector grows at a multiple of that. Okay?
Absolutely.
So if typically you will have, let's say, economy growing at a rate of X%, loan growths will happen at 1.5x, right? So I think over the long term, financial sector is obviously going to be a mainstay beneficiary. Another sector that I think for India is going to be always be the main driver of the economy is the consumption sector. And again, there are various pockets of consumption. There are mass consumption, premium consumption.
Yep.
Over the past 4-5 years, we have seen diverging trends in that sector.
Yep.
But I believe even as consumption grows, as economy grows, there's always a play towards premiumization. Right?
Absolutely.
So if people are buying soaps, as people start doing better, they will buy better quality soaps. Right?
Yep.
If they're buying cars, they'll start buying better quality cars. So you will always get not just growth of the industry, but also growth in the price point. So I think within consumption plays towards premiumization. The third, and that is probably true globally, in this new age, we have to look at digital businesses. Digital businesses can actually be an interplay with the other two themes that I spoke about. So consumer tech businesses, financial tech businesses,
Yep.
But even more broadly, so businesses, the platform businesses that are coming through, because many of these are literally building moats that are making them monopolistic.
Yep.
Right. So I think these 2-3 areas from a long-term perspective are probably very well positioned.
Got it. And amazing insights. Really glad to hear the sectors that you mentioned. Also validates a lot of our own internal research, because we are a bit overweight in banking in our own model portfolios. The consumers side that you mentioned, it's been pretty interesting recently.
Yes.
There's been a lot of talk about the Indian economy slowing down.
Yes.
There's been a slowdown in the FMCG demand,
Yes.
especially when it comes to urban demand.
Yes.
On the rural side, the dynamics are completely different.
Yes.
And there's often talk of India being two different economies.
Yes.
One that goes towards premiumization, and the other side, which is the mass market, where
Yes.
it's about reaching more and more people.
Yes.
So how do you see those sort of conflicting trends working together?
Yes. So I think that is true, but there's a lot of cycles within an overall economic cycle, right? So if you see 2 years ago, the rural economy were doing much worse, and urban consumption was actually holding up very well.
Yep.
And that's the K-shaped recovery that everyone was talking about post-COVID.
Mm-hmm.
But in last 6 months, that seems to have turned on its head,
Yep.
right? So we are seeing better traction in the rural economy.
Mm-hmm.
And in the last 6 months, for multiple reasons, there has been a slowdown in urban consumption.
Yep.
So I think those are cycles, but frankly, for retail investors, I don't believe they should look to time and catch every 6 months or 12 month cycle.
Agreed.
I think they have to kind of focus really on a 3 to 5 year journey. And I think over that period, these mini cycles will come and go. Right. What you should be careful of is try not to kind of buy things at peak cycle, because unfortunately what happens is at peak cycles both earnings and multiple are at their peak.
Yep.
Right.
Absolutely.
So if you buy at peak cycles, of course still over the long term you will make money, but the returns are much more moderate than if you are kind of buying things which are mid-cycle, and again it's impossible to catch everything at the bottom of the cycle, right?
Correct.
So I think just be careful that company don't have peak margins and peak multiples, and I think if company is competitive, it is gaining market share over its peers, etc., then on a 3 to 5 year basis, given whatever is the natural tendencies of India's growth coming from demographics, etc., should mean that you should be okay.
Got it. And that was very insightful, especially because people find it hard to determine what are those, sort of peaks of the cycles, what are the starting points. So I think comparing those multiples as compared to average values could be a good way for people to start.
And both, I think people should, so I think there is a lot of focus on multiples. So everyone focuses on where the multiples are.
Yeah.
I think people should equally focus on where the margins are compared to what's historically been.
Right. That's very, very insightful. And, when it comes to these trends, I think the reverse ends up happening in the market, right? Because people see something doing really well,
Yes.
a lot of money going into it,
Yes.
recent returns being phenomenal,
Yes.
and people pump all their money into it,
Yes.
right? So how would you sort of advise investors to avoid these pitfalls?
Sure. No, I think my favorite analogy is like do what you do while driving, right? You look in front, don't look in the rear view mirror and drive, right? So I think if you keep that in mind, I think you'll make less mistakes. I think the other thing is don't be enamored by the short term, right? Lots of time people get tempted because they have visibility. Okay, next 3 months this is looking very good. The order book is good. Our dealer is saying there's a waiting list, etc. Right? But that's a 3 month, 6 month phenomena. Right? So really, you are, and not just because of taxation, but I think really the probability of success goes up the longer your investment horizon is, right? And so I think if you take a 2-3 year view, I think you are less likely to be impacted by short-term news flow and bombarded with all the media articles around that. Because if you see in media, whatever they're doing well in the short term is what will dot the front pages of the newspaper.
Absolutely.
So I think if you keep at least a 3 to 4 year perspective that, okay, do I think this company even 3 years later will be growing at this pace, etc. I think that will help you avoid a lot of mistakes.
Got it. And that makes complete sense. And, we've been talking about investing into stocks. We've been talking about investing into certain sectors.
Yes.
There's also the concept of passive investing into a broad-based index, right? The key thing, no matter what you're doing, is to have a long-term time horizon, right? I think that's the key takeaway from what you said. But I want to now shift the focus to the broader economy.
Sure.
You mentioned we are all very bullish on the India story, and that is for good reason. How do you see the outlook for this India story, both in the near term and in the longer term? And what are some of the key factors that you think will contribute to this?
Sure. No, I think as has been evident over the past few months, there has been a slowdown in the industry. I think there are multiple factors driving it. There has been a fiscal consolidation that has been underway. There has also been some degree of monetary tightening, and unfortunately that is not unwinding as quickly as we expected because of pressures from the global economy. Because you would have seen, despite the Fed cutting rate by 100 basis points, US bond yields are up by 100 basis points, right? And that's put our currency under pressure. There are FI outflows, and banking system has moved from surplus liquidity to a deficit liquidity, right? So we have negative fiscal impulse, we have a negative monetary impulse, and our loan growth has fallen from about 16-17% to 10%. So all these factors have contributed to a slowdown in the economy, and I think some of these factors are changing. Government spending is coming back. We have a budget in another week, 10 days time. So we will get fresh direction towards the government spending plans for next year. But equally important is that we need to see more accommodative monetary policy. In the last month, RBI has started adding more liquidity to the market. But unfortunately, because there are still portfolios flows that are exiting the company, we are still running into a liquidity deficit. So I think that needs to change for the economy to kind of come back to full steam. I think, but within this construct, there are still some businesses that are doing well. Some businesses have slowed down. You mentioned the fact that urban consumption has slowed down. I think that needs to recover. For that, job creation is important. Lot of India's high-end job creation comes from actually the IT sector. There are expectations that with tax rate cuts in the US, there might be improved discretionary demand for the Indian IT companies.
Yep.
So that might also play a helping hand. So these are the factors I think we should look out for in the next 6 months or so.
Got it. So if you were to sort of just put it in layman terms, you expect the pain to continue for another 6 months, essentially.
Yeah, so I think really the two variables that you should look out for the turn in the cycle. One is what's happening to global interest rates and the currency.
Yeah.
And second is what is happening to the loan growth in India.
Right.
So if the pressure on the currency starts to wane, we can expect monetary policies to start easing. And again, the markets are always forward-looking, right? So if the monetary policy starts easing, the markets will not wait for signs of demand revival. They know because liquidity is coming back, demand will come back.
Right.
And same thing, if loan growth starts picking up, people will know that consumption and investment is picking up.
Right.
So I think those two, to my mind, are leading indicators that you should look out for.
Got it. And do you see a rate cut coming in India anytime soon?
Actually, I am not too focused on a rate cut because I believe this time around, unlike the say the US that had to hike up rates 500 basis points, the increase in rates in India was very modest.
Right.
And if you kind of just go back 18 months ago, even at this interest rate, the loan demand was strong enough. So I don't think it is rates that is keeping demand for credit low. I think it is availability of liquidity which is constraining demand.
Got it.
So I think that needs to change. Even if we don't get a rate cut, if we get liquidity, I think we should get growth back.
Got it. Amazing. And now let's shift our perspective to a longer term time frame. So if you talk about a 5 to 10 year outlook, what is it that retail investors should expect in terms of where their portfolio can be?
Sure. So I think for the longer term, people should look at returns being a function of nominal GDP. Right. So typically nominal GDP in India grows between 10 to 12%. And because the listed universe corporate sector tends to do better than that, their earnings probably grow a couple of percentage points better than that. Right?
Makes sense.
So that is the kind of more medium to long term return that people should look at. Of course, starting points are important. The starting point of valuations are important. The fact is that over the last 4 years, the markets have delivered returns which are much in excess of this 10 to 14% range. So there is some offset we will have to give for that in the near term. But in the longer term, I think a double-digit return, a couple of percentage points higher than nominal GDP is what investors should expect.
Got it. Amazing. And this is, I think, a very important takeaway because one of the most common questions that we get is the 30% return going to continue? Right? So, guys, the party doesn't go on forever. You need to put your expectations down to, as Ashish rightly pointed out, slightly higher than the nominal GDP rate. So that's an amazing insight and super important takeaway for everyone. Now let's shift our focus a bit global.
Sure.
We've talked a lot about the India story and the growth that's going to happen in the Indian financial markets. But recently there's been some interest in global stocks, in US stocks specifically, especially with the big tech sort of running the show, globally speaking. So how do you see that sort of affecting our portfolios in India? And do you think us Indian investors should get some exposure to these global markets?
Sure. So I think asset diversification is a must for every investor. And it has to happen across cohorts, right? So you don't need to just invest in equity, domestic or international, but you need to have exposure to fixed income. You need to have exposure to some commodities, at least gold or silver. So it has to be a diversified portfolio. and in fact, diversification actually leads to much better risk-adjusted returns over the longer term.
Right.
And again, depending on the investor, depending on his income, his demographic, his risk appetite, the percentage of international exposure can be different, but you should have some international exposure. Again, I'm not asking people to make strategic calls saying that you buy Brazilian fund or the China fund and you kind of flip around, etc. But really look at globally where is growth happening and have some diversified international exposure. Having said that, of course, US markets have given superlative returns over the last 5 years and again seem to be a consensus buy, so that is always risky.
Right.
And we all know the kind of returns the Mag 5 or Mag 7 have given.
Right.
Having said that, like I mentioned earlier when we were talking about sectors, that there are certain businesses which are becoming monopolistic, right?
Absolutely.
So whether you look at some of the innovation which is happening in pharma and healthcare industry, right? So the entire GLP-1 is probably being driven by one or two companies. If you look at AI, it is literally being driven by one country, and within that, just 4 or 5 companies are literally have bulk of the GPU capacity that is coming up, and there's only one company that is benefiting from all the infrastructure creation.
We know what that company is, right? The one that makes the shovels.
Yes. So I think given the fact that beneficiaries of some of these trends are concentrated just in the US, I think it is unavoidable but to have some exposure. Hopefully we will get some course correction during the year, because I think there is a lot of hype, there is a lot of high valuations, but I think some of these trends are longer term. So I think you should buy into that course correction rather than sell out.
Absolutely. That makes complete sense. And I think whatever you're saying is very practical. In the sense that apart from your Indian portfolio, you should have some exposure to developed economies, both in terms of diversifying with developing and developed, but also having exposure to themes that are not present in India, for example, or even having the US dollar hedge for currency fluctuations, given that a reality that a lot of our future sort of kids might go to countries like the US to study. So you do need to have a bit of currency hedging as well. So that's very, very insightful.
And actually for currency hedging, besides equities, actually an equally effective tool is just buy a gold ETF.
Gold ETF, right.
So I think that also holds value well. And in fact, if you look at last 10 years, 15 years, 25 years, you have got a return in excess of the dollar return if you buy gold.
Absolutely. And you sort of eliminate any risks of potentially the de-dollarization talks that have been happening on the side. So that's a very good one. So I think I'd like to end off with one very important question, right? Because you're someone who's an investment professional. You do this day in and day out. So how does that shape your own individual investment personality? Is it different from what you do? Is it very similar strategies as to what you do professionally?
It is absolutely very similar. And actually today, if I think of my own personal asset allocation, it literally is very similar to our AMC is AUM, which is 60% equity, 40% debt. Right. Of course, I have some bit of real estate as well, but otherwise it's very much in the 60-40 bucket.
Awesome.
And again, there I am literally not a churner, so some of the stuff that I have bought has been sitting there for years. So
amazing. And that's the right way to do it, guys. Even someone who's a professional sort of investment manager doesn't necessarily actively manage their portfolio, right? You sort of buy and hold, and that's where you make money. I think that's the most important takeaway I want to leave our audience with here. And Ashish, it was an absolute pleasure.
Thank you so much.
I'm
for
sure
having
our
me.
audience has learned so much from you today. So guys, if you did enjoy this episode, do give it a like, share, and don't forget to subscribe. And keep coming back. We'll have more conversations just like this so that you keep upping your investment game. Thank you.